You are 26 years old. You have a PhD in international economics. You have just joined one of the most consequential investment funds ever built. You do not yet know what you will learn here. There are no trading screens flashing on every wall. The office is quiet and filled with readers. You expected a war room. You found a library. You are in the right place. Your analyst cohort has 7 people. Each has either a PhD or deep practitioner expertise. Nobody here came from an undergraduate finance program. That is by design. You understand why immediately. Your first week assignment is not a financial model. It is a reading list, 37 items. You read them all. By Friday, you begin to see the world the way the fund sees it. The reading is the beginning. Elena explains the intellectual framework on day 3. She says, "This fund does not predict the future. It identifies situations where the market's model of reality is incorrect. Then you bet on the correction. Your job is to find those situations. Your desk is separated from the nearest colleague by 10 feet. The separation is deliberate. Macro thinking requires space. The space is the office's most important design decision. Your first thesis assignment is the Turkish lira. You have 3 weeks. You must develop a view on the currency's alignment. What direction, and by how much? You begin with the balance of payments. Your first week assignment is not a financial model. It is a reading list. 37 items. You read them all. You read the 37 items in 4 days. By Friday, you are beginning to see the world the way the fund sees it. The reading is the orientation. Elena reads the memo in 2 hours. She marks 7 sections. You answer 3 of the 7 questions immediately. You fill the other 4 over 2 days. The thesis survives. Elena explains the intellectual framework on day 3. She says, "This fund does not predict the future." The thesis moves up the chain. You watch it leave your desk. You built the case. You do not decide whether to trade it. This separation keeps your analysis honest. You spend 2 days with the reflexivity framework. Before you begin the lira analysis, you draw the feedback loop on your whiteboard. Markets affect fundamentals. Fundamentals affect markets. The loop runs in both directions simultaneously. Your first assignment is the Turkish lira. You have 3 weeks to develop a view on the currency's alignment. You begin by reading the country's last 5 years of balance of payments data. You close the deal on the software company. You are 23 years old. You built the model that justified $1.4 billion. You will think about this number for a long time. You build the current account analysis first. The deficit is structural, not cyclical. You verify this against 12 quarters of data. You attend the IMF meeting to stress. Test your developing markets thesis. You bring your framework. They bring their data. You each give the other something you didn't have. You return with a stronger thesis. You write 12 pages. You argue the lira is overvalued by 18 to 22%. You build from 4 analytical angles. Elena reads the memo in 2 hours. She marks 7 sections. For 3, she asks questions that you can answer. Elena marks 4 sections that reveal gaps. You spend 2 days filling them. You write the vocabulary in 2 columns. Conviction language on one side, uncertainty language on the other. You learn to read position sizing through the language. The language tells you what the fund believes. You present to the research group, 6 analysts who have been here between 4 and 15 years. The thesis moves up the chain. You watch it leave your desk and enter the institutional decision-making process. You built the case. You watch the thesis leave your desk. You do not know if it will result in a position. The separation of analysis and capital allocation is the fund's discipline. You build the thesis. You read everything available about the 1992 pound trade. You read the original period memos. The mechanism was clear. The policy commitment was the weakness. You study why that matters. Your European sovereign thesis takes 9 months. You argue the spread compression is flow-driven, not fundamental. When flows reverse, spreads widen. You know when. Your thesis says when. On the day Sterling left the arm in September 1992, the fund made approximately $1 billion. The fund's intellectual history is in the memos. You read 20 years of archived research. You read the 1992 memo from the period. The analysis is specific about the mechanism and the timing. The mechanism was right. Year 2. Your theses are more complex. You connect 3 markets into a single narrative. You have learned that isolated theses miss the connections. The connections are the insight. Year 2 begins with a different kind of assignment. You are building a thesis that connects three markets simultaneously. The connections are the analytical challenge. You understand something now that you didn't understand at the beginning of year one. A thesis that touches three markets has more ways to be right and more ways to be wrong. You present at the research session. You are at the front of the room where you once sat at the back. You welcome the challenge. You built the thesis to withstand it. You meet with IMF economists to test a developing markets thesis. They have data you don't have access to. You build three scenarios for the central bank decision: hold, cut, signal. Each has a different market impact. You model all three. You travel to the ECB's academic conference to present a research paper. Year 7. You have a portfolio book. You allocate capital within your mandate. You build the thesis. You size the position. You manage the risk. The analysis and the capital are now yours. You don't need to know which scenario occurs. You need the market to have mispriced the probability. That is reflexivity in practice. You observe the strategy meeting. You are the youngest person in the room by 8 years. You say nothing. You size the Japan position for uncertainty. You are highly convicted on direction. You are moderately convicted on timing. Your sizing reflects both variables. You hold the size below full conviction until the trigger advances. You write the vocabulary in 2 columns. Conviction language on one side, uncertainty language on the other. You spend a month studying how the most senior portfolio managers describe their positions in strategy sessions. The language is precise. You write a thesis that challenges the consensus. The consensus says China's growth trajectory is stable. The challenge runs 4 hours. You hold most of the thesis. You concede 2 points. The conceded points improve the thesis. Elena reviews your year. She says, your analytical framework is strong. Your conviction calibration is weak. You work on conviction calibration for 6 months. You build a calibration journal. Every thesis you develop is given a probability. Your calibration data shows a systematic bias. You overstate conviction in theses where the mechanism is clear, but the timing is uncertain. You write it, conviction calibration. You understand what she means. You have been sizing 40% ideas and 80% ideas the same way. You correct this across the book. Year 4. Senior analyst. You run 4 concurrent macro theses across 3 asset classes. Year 4 begins with a larger mandate. You are running 4 theses, not 2. The machine inside Soros Fund Management runs on the question of what the market is wrong about. You have been part of the machine for 7 years. You contribute 1 clear question at a time. Your European thesis takes 9 months. You argue the spread compression is flow-driven, not fundamental. When flows reverse, spreads widen. You map the trigger sequence: ECB policy shift, investor positioning change, political risk event. You don't need all 3. You develop your primary research methodology over year 3. Before every significant thesis, you contact 3 primary sources: an academic, a practitioner, and a government-adjacent economist. Each gives a different layer. Your primary research travel budget in year 4 is larger than in year 1. The fund invests in the research. You travel to 3 European capitals for primary research. You meet government economists, central bank staff, and private economists. The travel is the research. The models are the starting point. The economist doesn't tell you policy intentions. They tell you how they think about the data. That is more valuable. Intentions change. You return from Europe with the thesis refined. The trigger sequence is now 12 months tighter than your original estimate. After returning from Europe, you rebuild the thesis with the primary research incorporated. The trigger sequence has moved forward by 12 months. You present the updated thesis to the research group. The challenge is shorter than the first presentation. Your answers are faster. The spreads begin widening in month 7. Your trigger sequence said month 8 to 12. The thesis plays out over 4 months. You update the framework every week. The question is not whether you were right. You present at the research session. You are at the front of the room where you once sat at the back. You run the research session with the rigor, Elena, applied to you. After the research session, you meet with each analyst individually. You give specific feedback on their mechanism clarity. You explain the framework to your junior analyst. You say, the thesis starts with the model the market is using. She writes it in 2 columns: market model, correct model. The gap between the 2 is the thesis. Year 7, portfolio manager. You have a book. You allocate capital within your mandate. You build theses. You size positions. Year 7 begins with a new responsibility. You are not only building theses, you are building the book. You think about the book the way you think about a thesis. What is the book's core view? Your Japan thesis takes 11 months to develop. The complexity requires that time. You don't rush it. A thesis that moves faster than the evidence is not a thesis. It is a position. You map the mechanism. BOJ buys bonds. Balance sheet expands. Yen depreciates. CPI rises. The Japan thesis challenge runs 6 hours. The strongest objection. The Bojo has demonstrated multi-year tolerance for the contradiction you are identifying. You size the position for uncertainty. High conviction on direction. Moderate conviction on timing. The sizing reflects the second variable. You build the Japan position over 3 months. You build it slowly because the timing is uncertain and the carry is meaningful. You size the Japan position at 40% of full conviction. The direction is clear. The timing is uncertain. You travel to Tokyo. You spend 4 days meeting economists, fixed income analysts, and one former Bojo official. You learn things the models alone cannot tell you. The local context enriches the model. The strategist describes the political economy of the Bojo's position in language the data doesn't produce. 9 months in, the direction is correct. The timing is extended. You review the carry cost monthly against the thesis conviction. The carry is acceptable. The thesis is intact. You hold. 9 months is a long time to hold a position with meaningful carry cost. You have held incorrect positions longer than this and been wrong. You have held correct positions this long and been right. You run 3 live theses. Japan rates. An emerging market currency in Latin America. The risk review is monthly. You present your 3 positions. For each one you specify the thesis, the conviction level, the risk reward, and what would make you exit. The exit thesis is required. The risk review forces you to be precise about conviction. The risk committee asks, what would change your view? You develop a position template for the risk review. Thesis summary. Conviction level. Position size. Risk reward. Entry trigger. Exit trigger. You write the exit trigger before you write the entry thesis. If X happens, you exit. The trigger is not a price. In the 3rd year of your book, correlations break. Your 3 theses all move against you, simultaneously, in a single month. Elena reviews the decision. She asks, why hold? You explain the difference between thesis invalidation and liquidity pressure. All 3 theses resolve in the correct direction over the following quarter. You review the episode carefully. Year 10, Senior Portfolio Manager. Your mandate is larger. Your positions are more complex. The machine continues running above you. The theses develop. The positions run. The framework persists. The machine is judgment applied continuously. You are 10 years of its accumulated application. You understand something now that you didn't understand at year 1. The fund's edge is not information. It is framework. The leadership conversation is about where the market's model of reality is most wrong. You argue 3 areas. You run the research session. You challenge the junior analysts, the way Elena challenged you. You look for conviction calibration. You challenge junior analysts the way Elena challenged you. You look for conviction calibration. You look for the exit thesis. After every research session you hold office hours. Junior analysts can bring developing ideas. The ideas are usually too early. You ask the analyst, what would make you wrong? If he can't answer this question, the thesis isn't finished. He specifies the exit thesis. You nod. The thesis goes to the fund's consideration. You read the original memos from major historical positions. You compare the analysis to the outcome. The historical memos are the fund's memory. You read them when you are working on a thesis with historical precedent. You compare your current thesis architecture to the historical memos. You are looking for structural similarities that might inform the mechanism timing. You attend political risk briefings quarterly. The geopolitical context changes the probability distribution of market outcomes. The central bank access is formal and public. The deputy governor speaks at a conference you attend. You write the annual strategic thesis. 6 weeks, 40 pages. The highest conviction macro view you can build for the 12 months ahead. The thesis informs the portfolio regardless of whether it is traded. The annual strategic thesis is the fund's intellectual signature for the year. You have read 10 years of annual theses. You write the annual thesis the way you write every thesis. What is the market model? What is the correct model? The annual thesis is the fund's intellectual stake in the ground. You have read 10 annual theses. The quality is consistent across the decades. You aspire to that standard in yours. You review the year. 3 theses resolved in your direction. 2 did not. Your analytical journal has 10 years of entries. You read backward, sometimes. You have 3 recurring weaknesses. You overstate conviction when the mechanism is clear, but timing is uncertain. The analytical journal is the most valuable tool you have. It makes your patterns visible to you. You read the archived memos before you build your first thesis. You want to understand how the fund thinks before you think for it. You annotate the alchemy of finance. You connect the theory to market examples you know. You attend your first research session as an observer. The challenge level is unlike anything from your PhD program. Your first macro model is simpler than your PhD models. The simplicity is the point. You find a contradiction in the data. 2 indicators should move together. They have been diverging for 4 months. You work late because the question is not closed. The thesis is only finished when the mechanism, the magnitude, and the exit conditions are all specified. You are not finished. You write the 1-page summary after the 12-page memo. The 1 page forces you to know what is essential. You attend the political risk briefing. The political context is not separate from the currency thesis. You read the 1997 Asia crisis memos for the Turkey thesis. The structural similarities are not exact. You run the calibration exercise every 6 months. You stated a probability. You track the outcome. You sort the European sovereign universe into 2 categories. Structural buyers, their debt is held because the fundamentals support it. 3 countries with the most vulnerable profiles. You focus on the one where political economy limits the policy response. Limited response makes the spread widening more severe when it comes. You attend the sell-side conference on European credit. The consensus view is that spread compression reflects fundamental improvement. You disagree. You stress test the thesis against tail scenarios. What happens if the spread reversal triggers a sovereign stress event? You monitor the trigger indicators every day. For 6 months, they move slowly in the predicted direction. Your monitoring spreadsheet has 12 indicators. Each one has a threshold. When an indicator crosses the threshold, you update the trigger status. The Japan thesis is the most complex you have built. It requires simultaneous views on monetary policy, currency, inflation, and political economy. You organize it on 4 whiteboards taped together. You photograph the 4 whiteboard architecture every evening. The diagram changes as you add primary research. You watch every BOJ press conference. The governor's language changes subtly over time. The language change precedes the policy change. The position is correct, and the market has not moved. This is the hardest state to manage. You are right. You run the rapid analysis in 4 hours. You separate thesis from market. The theses are individually intact. You reassess each thesis against the data. All 3 are valid. The market's recent movement contradicts all 3 simultaneously. A geopolitical risk event could affect 3 of your theses simultaneously. You build the scenario framework for the event. You review last year's annual thesis against the actual outcomes. The directional calls were correct on 4 of 5. Your methodology document has evolved over 10 years. You add 2 principles from the Japan experience. Timing errors cost more than directional successes earn. The document is the accumulated lesson. You attend the annual review as a portfolio manager. The fund's returns over 10 years are reviewed. The 1992 trade is still the benchmark, not for size, but for clarity. The mechanism was clear. The thesis was specific. You give a lecture on reflexivity theory at a university. You describe the framework without describing the fund's positions. The unanswerable question becomes a research thread. A question you cannot answer is a gap in your framework. The gap is valuable. You contribute to the methodology review. You argue for a more formal exit thesis requirement before any position is approved. Your Friday review discipline is unchanged across 10 years. Every position is the thesis intact. Has any new information invalidated an assumption? You measure your development not in titles, but in questions. At year 1, you asked, what does the data say? At year 10, you ask, what model is the market using, and is it correct? You compare a year 1 entry to a year 10 entry on similar thesis types. The year 1 entry is longer. You and Elena work through a shared question at the whiteboard. The whiteboard is full in 30 minutes. You look at the market from above, not literally, but the macro framework gives you a perspective that is above the individual position. You see the mechanism playing out over years. That view is the product. The fund did not implement one of your highest conviction theses. It played out in the correct direction over the following year. You write the misthesis post-mortem the same way you write a failed thesis post-mortem. What was the thesis? You open the annual thesis document. The title page is blank. You write the title last. The thesis comes first. You write the fund's organizing question at the top of every annual thesis. What is the market wrong about? You work on the annual thesis on Saturdays. The work requires undivided attention. The undivided attention requires Saturday. The office is small relative to the capital it manages. The ratio of assets to people is exceptional. The thesis is complete. 100 pages edited to 40. The editing is the final analytical test. You print the final draft. You set it on the desk. You review the first page, the middle, and the last. You turn back once at the exit. The lights are on upstairs. The work continues. The institution continues above you. The theses develop. The positions run. The research group challenges. The framework persists. Above you, a 26-year-old is reading the 37 items on her reading list. She doesn't know yet what she is reading. She writes the word. She draws the loop. The loop will take 10 years to fully draw. She has started. She opens her thesis. She begins with the market model. She asks, what is the market wrong about? The machine takes another step forward. Somewhere in a Manhattan office building at dawn, a 26-year-old with a PhD in international economics is arriving for her first day. She has a reading list, 37 items. She opens the first document. She reads. A senior analyst stops at her desk on the third day. She asks, what is the market wrong about right now? The machine takes another step forward. The theses develop. The markets are wrong about something. Somewhere in the data is the mechanism.